Well, our next guest says that although UK wage growth remains well below inflation, employment growth is firm. He says this opens the door for another rate hike from the Bank of England once there's more clarity on the Brexit front. For more, we turn to Ashraf Lady. He's CEO of Intermarket Strategy. He joins us from London. Ashraf, it's always good to talk to you. How much more clarity does the Bank of England need on Brexit, and when is that clarity going to arrive?
Hi, Paul. How much of the clarity the Bank of England needs? Let's ask regarding the politicians how much of the clarity that they need. They're not very, very sure. What's interesting regarding the pound here is that sometimes you have, well, in the last 2 weeks, even though you had some sort of disappointing data, with the exception of today's good news on the job front, the pound has been quite resilient in the face of some disappointing data, as long as there was hope that there was some sort of agreement on the Brexit regarding the citizens' rights before the end of the year. If you look at the pound, it's been, interestingly, it's been a striking ability to hold above 130.60. Today we are pushing higher, mainly because, well, part of the reasons is due to weakness in the US dollar all across the board, but the unemployment rate remains at a 30-year low at 4.3%. Wage growth is 2.2. Inflation is at the 3%. So you may say, wait a minute, wage growth is well below inflation, so real wages are quite low, are below zero. How are they going to raise interest rates? And I think what the strategy, Paul, is by the Bank of England, because they've been saying that the above target inflation is mainly due to the pound weakness of the last 2 years. So what do they need to do? They're not going to raise rates because wage growth is weak. They're going to need to talk up the pound. How do they do that? This currency rhetoric policy, basically keeping hopes, keeping expectations that there is going to be one more rate hike if the situation on the Brexit becomes clear. This way traders lift the sterling, and that holds for another 6 to 12 months, it will bring down inflation a little bit, so they will do the bringing down of inflation by other currency and not having to raise interest rates.
That's really interesting to see the dichotomy between sort of the employment and the lower level of wage growth. So that would suggest there's not a whole lot of pressure on wages as people are trying to hire into the business. Now, is the participation rate going up or down in terms of people looking for employment, or is it a factor of more people are not looking?
Yeah, it's more people. No, the participation rate is not really falling, but the dichotomy between wages and unemployment or employment is not very, very dissimilar for what's happening in the United States. We have not been really seeing the required jump in the average hourly earnings. But in the case of the UK, yes, a lot of jobs are part-time jobs, but there's been an inability. They say jobs are hard. Employers, it's very hard for them to find the real employees or very, very qualified employees. That does not mean that the person who gets the job will have a high pricing power. And it's the same in the United States. So this is a situation, I think it's all around the world, this suppression in wage growth, which has been part of the reason, or trying to help explain the mystery that Janet Yellen has had regarding inflation.
We will have to leave it there. We thank you very much. Ashraf Lady, he's CEO of Intermarket Strategy. He joined us, of course, from London.